Well, good afternoon. Time to have a look at the markets. The Asian side had investors worrying about the impact of the new U.S. rules relating to the chip makers. Nonetheless, we did see a bit of a mixed performance on that particular front, with some of the markets trading in a little bit mixed compared to the picture that we saw yesterday. And this is in a background where global markets have retreated back to levels we haven't seen in 2 years, weighed down by the Ukraine tensions. We also have rapidly rising interest rates, as well as China stepping up their COVID curbs in order to deal with some of the new cases that have popped up. And then you add in some of the investor nerves, some frayed nerves on that front as investors look ahead to US CPI figures that come in on Thursday that could set the stage for another 75 basis point hike by the Fed in November. Already the futures market pricing in a 90% chance of that happening. Looking at the Rand right now, trading at around 18.16, Brent 2% lower, $93.99. And then locally on Sens, we had Sanlam, which has its eye on a majority stake in AfroCentric, offering about 6 Rand per share. AfroCentric worth around 3.4 billion Rand, and it is the majority operator of MedScheme. However, to talk to us about the market dynamics and what we can look forward to as the week unfolds, we are joined by Martin Smith from Anchor Capital. Martin, thank you so much for your time. In an environment of so much unease and fragility, how is the JSE holding up, given the fact that yesterday the performance wasn't necessarily too great?
Yeah, so I think we've held up relatively well throughout the course of the year, if you look at it relative to the rest of the world. But in the last month or two, we've really been experiencing kind of sentiments like we've experiencing across the world, where markets haven't sold off, and the JSE hasn't been immune to that. The only real market that has is essentially in Brazil. So sentiment really starting to catch up with us. But the difference between us and somewhere like the US is that our market is still looking quite cheap relative to history from a valuation perspective, where the US isn't looking cheap just yet. So I think you are getting some bargain hunting coming into the play when it comes to JSE, and specifically on the small and mid-cap space. But again, we are starting to get caught up in the kind of risk-off appetite that's plagued the world for the last 9 months or so.
Speaking of that bargain hunting, I mean, it's the month of October. So far, if you had to pick like a top 2 winners and losers, what does it look like on your screen right now?
Look, there hasn't been a lot of places to hide. I mean, like I said, we've been in a very, very negative kind of feel in the market in the last month or so. Ever since that CPI number from the States came out last month, you've had real negative sentiment kind of go through all over the show. So I think if you're looking for something now, you can pick up a lot of great companies, things like Naspers, Prosus, things like the banks specifically, something like Apps is looking really cheap. I think in South Africa, you've got quite a big range of potentially very good outcomes from stocks in the 2, 3, 4, 5 year view. So I wouldn't be shy to pick up here. Offshore, I'd maybe be a bit hesitant still.
What do you make of this sort of theme I've picked up in terms of what the Fed officials or presidents are trying to signal in terms of how they're going to be dealing with inflation and future interest rate hikes, and what the market is thinking they're going to do? Because a while ago we were talking about a Fed pivot. Now we seem to have pivoted from the Fed pivot. So how are you making sense of these dynamics?
No, I think you're right. I mean, I think initially the kind of general investor was maybe a little bit positive, and the Fed has really started to kind of hit home about the fact that this is not going to be a quick, short story, and then next year things are going to change and interest rates are going to come all the way back down. So I think that's the big thing is next year. I think a lot of investors were very positive, thinking, okay, cool, next year the market's going to kind of reverse in terms of interest rates and things are going to look rosy again. But the Fed really has been hitting down that nail, saying, guys, we're not out of the woods yet. Interest rates are not going to come back down as quickly as they've gone back up. And now I think we've almost gone from being too positive about interest rates next year to being too negative about interest rates next year. So it's a bit of a tough position we find ourselves in at the market.
Which is a nice segue into my next question. We've got U.S. earnings season starting on Friday with the banks, leading the charge. What are you going to be looking out for this particular season?
So I think if we look at this season of earnings, in this last quarter, consumer the consumer still in good shape. The environment trading wise is still relatively good shape. I think it's more about not this last quarter. It's about the outlook going forward, because then you'll start to see effects coming through, interest rates, inflation and the like, and see how constrained the consumer actually might be. We're looking for about 6% growth year on year for these results in aggregate, and about down 2% from a quarter on quarter perspective. So if the market hits, if it hits that, I think the market will be happy, because obviously it likes kind of surety. But I think the big thing is essentially outlook and what things are going to be going forward.
On Thursday, I mentioned in my opening intro that we have US CPI figures coming out. What's the market expectation here?
So from a headline perspective, which obviously includes oil and food, we are expecting it to go from 8.5 to 8.1. From a core inflation perspective, we are looking for it to go from 6.3 to 6.5, so up a little bit on the core headline perspective. It's going to be a very interesting thing to see how that pans out, because again, we saw real negative appetite come into the market on the back of the last CPI update. We obviously also had those jobs numbers out on Friday, which were not in line with expectations. So again, we are so data and kind of headline driven at the moment. I anticipate this being quite a big driver of markets in the next couple of weeks.
So when your clients are calling you, I mean, what's the main concern? Is it inflation or recession? And how are you calming investor nerves at this point?
It's a good question. No, it's tough out there, specifically globally. Like I mentioned, there's really been nowhere to hide. I mean, markets are down 25, 30, 35%, and you've seen some really big blue chip names getting caught up in that, and plus some. So I think insofar as there is the recession versus inflation kind of debate, obviously they're a little bit linked in this instance. But I think if you look at a recession essentially is a cure for inflation in a lot of ways. So it means you're kind of closer to the end than you are to the beginning. So hopefully a recession will at least end this kind of last cycle that we're in, bring inflation back in line, and then we can kind of push on from there. I think we also need to remember that it's not a massive systemic thing in the background like we saw in the financial crash of 08 or 09. It's that consumers are in a lot better shape, but the balance sheets are in a lot better shape. So I think it'll be a relatively shallow recession should it come, which probability is that it will.
Martin, thank you so much for your time. Let's leave it there.
Thank you.
That is Martin Smith, who's a portfolio manager at Anchor Capital, giving us his perspective on the markets and also telling us what we should be expecting on that Thursday US CPI figure. We're going to take a quick break. When we come back, we'll have more news for you. That's it from me.